Hello, this is Nick. Welcome back to On the Brink. Today we're sitting down with Leo Zhang, the founder of Alkimiya. Alkimiya is a block space market infrastructure company allowing users to take a view on, for instance, Bitcoin transaction fees, Ethereum gas fees, things like that. Today we're talking about Alkimiya's Bitcoin fee exposure product. I think there's a lot of reasons why consumers of block space might want to take a view on Bitcoin fees if there is a mint or runes or ordinals that they expect to drive up fees, or if they are structural buyers of block space and want to lock in a consistent price for their fees. This is a market that I think needs to exist, and I'm glad that Alkimiya is doing it. Leo is one of the smartest thinkers in this domain and has written a huge amount on the topic, so I'm very glad we're finally able to get him on the show. We talk about the effect that Alkimiya might have on Bitcoin fees, the effect of L2s and non-fungibles on the Bitcoin fee market, and the general long-term outlook for Bitcoin fees and how that affects the security budget. And as a disclaimer, Castle Island is an investor in Alkimiya, and nothing said on this show should be construed as investment advice. Let's dive right into it. I'm sitting down here with Leo Zhang, founder of Alkimiya. Leo, welcome to the show.
Thanks for having me.
We've known each other for a very long time, since I want to say 2017, 2018. We haven't had you on the show yet, which is kind of surprising.
Yeah.
We first met, you were doing Bitcoin mining, and you're kind of still adjacent to that today. Still kind of the same theme.
Yeah, it's pretty close. I mean, the Alchemia has gone through several iterations at this point, but there's always some relevance to it. Actually, when in 2020, when I was not sure if I wanted to start this project, I consulted quite a few people, and if you remember, you were one of them. And the conversation, I think we had at least 3 rounds of conversations, and you gave me a lot of confidence. You were sort of one of the reasons that I decided to okay, let's do this.
Well, it's my job to tell people to start companies, so don't feel too special. Just kidding. I'm glad you did. Yeah, it's been an interesting journey with Alkimiya, covering sort of the block space resource market. I would say that's sort of the overriding trend, is that block space itself is a valuable resource. That wasn't always a popular idea, but I think it's getting very popular now as we see kind of sustained fee pressure in particular. So yeah, take us through kind of the history of the Alkimiya and then sort of your flagship product today.
Certainly. I've been always interested in the dynamics of block space. I think when we first started the project, the interest was much more on the supply side, right? This is the block production, this is mining, this is staking validators at the time are still mining. And that was because in the early days, the miners have outsized impact on the block production. I mean, they still do, but they have a lot of power in how the direction of these public blockchains could go. We've seen, quite a few block size wars before where miners have had outsized impact and led to some interesting outcomes in the Bitcoin space. As the I think application space evolves, especially with Ethereum first, there are a lot more interesting patterns that emerged that gave other specialized players more power in the block building process, and people realized, okay, there's some responsibilities that we should break down into different parts, and some part of the stack should be assigned to more specialized players rather than concentrated in the hands of one category of players. So we see that evolve quite a bit. And I think as a result, the demand side of block space economics is becoming much more interesting compared to when we started our first round of conversation. In 2020, when we talked about this concept, it was still largely around, okay, how miners should hedge their economics because they have relatively predictable cost of production, and that cost of production is essentially a one-way street. The global difficulty is on the longer trend is always increasing. The game is becoming more and more competitive with every 4 years. The halving decreases the amount of block rewards that people can earn and place a greater emphasis on the ability to capture more fees. So I'd say that has changed a lot in the past 4 years, and that shifted our thinking and our focus as well from originally more on okay, how do we secure the block producers' economics? How do we guarantee more steady production? To okay, how do we provide more stable, more predictable experiences for consumer block space? This include more frequent users of block space, including exchanges, trading firm, wallets, services, bridges, rollups, and the future Bitcoin L2s to end users who are just trying to mint their favorite NFT collection or ordinal collections, and they're getting sniped left and right, and they had to pay massive fees in order to get what they want.
So tell me about the nature of the protocol as it exists today, or I suppose you're launching next month, in terms of taking a directional view on Bitcoin fees.
Yeah, so the essential idea of Alkimiya is that we're trying to build a block space resource market. We want to turn it into an infrastructure that can be plugged into service providers such as bridges, exchanges, wallets, all of these type of players that had to frequently settle on chain. And so for these guys, the volatility of transaction fee is really unpleasant. It's just in traditional markets, there are a lot of there are a lot of examples of how these kind of patterns have developed in commodities market, in energy markets. There are a long history of people, utility companies hedging against the fluctuation of energy costs. Right, they will use futures market to place on to lock in their monthly average cost, and for some of the more speculative, event-driven users, they were able to use this kind of contract to speculate on the impact of Russian-Ukraine war on oil price in short term, right? So we think that the public blockchain have evolved to a point where this kind of steady businesses, the kind of mature commerce are starting to emerge. And for these kind of businesses to have more sustainable expense management, they will want similar kind of experiences to similar kind of tools to manage their expense. So in short, Alkimiya allows this type of users to create financial instruments that allow them to have long or short exposure on average transaction fee over a period of time.
So walk me through the kind of typology of users that you feel would be interested in both the long and the short side of the trade.
Yeah, so for the user on the long side, so someone who are looking at let's say activities on Magic Eden, they expect to see a large runes collection to really move the interest for a lot of collectors or traders, and these kind of activities tend to move in cohorts, right? And people who expect that there will be congestions as a result of these activities, and they will be able to take a long position on transaction fee before this kind of activity starts, so that by the time that they finish their interactions with these collections, part of their higher expenses for minting costs or trading these things will be offset by their gains on longing the transaction fee itself.
So if you know that you're going to mint a big collection, or you're going to create a mint event and third-party users are going to mint, it's going to be competitive, and you want to preemptively abate those costs, that's when you would go long fees.
Yeah, this would make sense if you're a large collector, a large trader, or if you're the collection itself that wants to create a better, user experience for your community. I think it was 2022 or 2021. The time blanks me. It was May when the Bored Ape had a really popular drop, And I remember something like
Other side.
yeah, other the and the users collectively paid 150 million in gas, and this is just the transactions that were rejected, right? They didn't successfully mint the collections. So you guys had to come out and apologize to its community, and I think they said something like they're going to refund part of the gas cost to users who didn't successfully mint. So this kind of experience they happen quite often. Right? This started with CryptoKitty days, but at the time people didn't realize this is such a recurring pattern. This is something that's inherent to the supply and demand of block space, and um, I mean this if we really want to trace the history of this, I think counterparty the kind of early signs already shown and in 2013, 2014, and this is just a continuation of all these same kind of supply and demand split that happened multiple times in the history of public blockchain.
What is the nature of the contract? Like the contract specification? Is it a perpetual? Does it have an expiry? How does it work specifically?
It has an expiry. The contract, the index tracks the average transaction fee across a period of time. The increment of the index is the median set per VB of every of the block. So this way, we use median because we want to get rid of the outliers in a block, which still happens a lot. As you know, people still fat finger transactions. I think not so long ago there
Yep.
was a 80 big Bitcoin transaction attached to a transaction or something like that, and whichever pool that miner was trying to return the fee to the whoever did that. So these things happen; they still happen, right? And we want to make sure that this index tracks the sort of the most normal experience of interacting with Bitcoin. So outliers we want to get rid of, the kind of transactions at the bottom, because they're all sorts of like operational transactions that mining pools they handle, or some of the transactions that has really low urgency. We want to get rid of them. We don't filter them out as well. So median is sufficiently resistant to this kind of outliers and manipulations. So we use that as the increment of the index, and the payout of the contract tracks the rolling average of the median of every single block across that period of time. The reason we use average instead of the perps was the first thing that we explored when we designed this market, and we quickly realized, given the nature of the volatility of this kind of index is very different from a pump and dump shitcoin, where those things are also very volatile, right? But they tend to go up a lot and then drop off of a cliff, and then go up a lot and drop off a cliff. This kind of rinse pattern, which is still relatively easier to manage if you have a perp. But for something like transaction fee, where intraday have incredible amount of like spiky pattern, it's very difficult if you require the one side to maintain margin. If you just constantly getting called. So given that our target users are these service providers, wallets, they don't necessarily want to become, they absolutely do not want to become traders themselves when they interact with contracts like this. So I can't really be like, hey, you guys need to post margins for hedging your fees in the middle of the month. That creates a very undesirable experience for both the protocol as well as for the end users. So we opted for something that's more stable, something more straightforward, where the users they interact with these contracts, they don't have to think about it again until the expiration date. And given the expiration date, given the averaging nature of the payout, some kind of averaging date would make sense.
Do you worry about banging the close? I mean, basically manipulation of the block space market to cause one of these contracts to settle in the money or out of the money?
So given the averaging nature of it, it becomes harder and harder to manipulate especially towards the end of the contract. So in energy futures market, this is how a lot of long-term contract works as well. The utility companies, they will hedge the average electricity price of the entire month or up to 3 months. And because it doesn't really make sense for them to do like a shorter interim, right? So for this market, a longer averaging period for some of the more the kind of services that are closer to utility companies, if we have any in crypto today, that will be the type of experience that they desire. They really don't want to manage like margin positions. They would rather not have a high leverage to have something that's takes less time to manage. And for intra-block manipulations, it's really just for Bitcoin specifically, only the miners that have only the large solo miners are able to manipulate transaction fee, and this is because most of the mining
Right.
pools today they're on FPPS payout, and if the mining pool operator wants to push up the transaction fee in that block, they have to self send, and they attach a massive amount of fees to that self send transactions, and they have to share that fee with everyone else on their mining pool. So that becomes a massive cost. Unless they have, like, I don't know, a $5 billion worth of long position on Alkimiya, then maybe that justifies then I don't complain about that. but it's really hard for them to do that and justify that. In fact, the only pool that's probably capable of doing that today is Marathon, because they're a solo pool. They have sufficient amount of hash rate. They're sophisticated, but I doubt that they're willing to do something like this, given that they're a public traded company.
So this system is built on a base on Ethereum. It pertains to Bitcoin, but you're building it on Ethereum. How does that work?
Yeah, so it is written in smart contract. We do require a smart contract. It's there's just no tools on Bitcoin for us to use at the moment. Well, there's no
What about the
tools.
Bitcoin L2s?
They can show us when they're ready. I mean, we've gotten no shortage of interest from various Bitcoin L2s that try to get us to deploy there. For us, the consideration is really that we'd love to explore that when any of them are ready, but we also do require sufficient amount of liquidity in order for this market to work well. And of course, using RAT BTC is not ideal. It's not true to Bitcoin ethos. Let's be real. Like a lot of these Bitcoin L2, a lot of these EVM compatible Bitcoin L2s, their solution is no better and dare I say worse than BitGo.
Careful which Bitcoin L2s you criticize, sir.
Some of them.
So use wrap Bitcoin on base on Ethereum.
Indeed.
That's the main collateral. Yeah. What kind of entities would take the short side? Who wants to short Bitcoin transaction fees?
Miners. So with the most recent halving, mining fee has become a larger portion of the block rewards. I mean, still, it's not enough to become I mean, it's not 90%, but it's high enough. So there are two things that makes it interesting for the miners. One is the increasing fee to reward ratio that we just mentioned, and second is there's expectation for greater volatility of transaction fees as a result of ordinals, runes, just a cultural shift in Bitcoin lands and how people want to use Bitcoin. So these kind of activities as a result, there's less predictability on the revenue for miners. It becomes interesting. It becomes a very interesting financial instrument for miners to partially lock in the future revenue on the fee component. This is, of course, a little different from trading hash power itself, where the contracts are denominated in petahash over month or something like that. These contracts are still denominated in transaction fee. They're denominated in set per VB. So for miners, of course, they need a little bit of conversion. It's not really a hedge angle, but it is a pretty potent tool for them to increase their earnings, or be able to capture some of the premium when the markets are excited about certain events.
So there have been some analogous systems like Alkimiya, I think, that have existed, like the gas token in Ethereum. Do you remember that?
I do. Gas,
back in the day?
yeah. So gas token. This is created by IC3 Phil Diane in 2018.
Yeah.
I think so. Gas token works very, very differently because, well, so gas token essentially take advantage of it and exploit, which has subsequently been removed. That opco has been subsequently removed in London fork, if I remember correctly. So essentially, it allows gas refund when you for when you claim when you essentially burn these gas tokens. So they sort of work as a gas battery of some sort, where they lock up the amount of gas units from during time of low gas, and you're able to release them in the time of high gas. This is a very awesome experience for average users, but it is a very undesirable experience for the producer of the book, because the miners, well, they were still miners at the time. They get strictly worse economics. They get strictly worse
Right.
economics for having this kind of like majority of the gas fee paid through this type of interactions. And also, the state bloat was very, very difficult to solve. I remember Vitalik actually wrote whether a blog post or an ETH research post about this. He was adamantly against it, and the subsequent the opco responsible for gas token was subsequently removed, and therefore killed gas token, the Chi token, and the variants that represents this kind of gas battery. I think the moral of the story there is that it's very difficult to create this kind of physically settled block space where you remove essentially computational cost from a low gas cost space to a high gas cost space, because block space production, the supply and demand is inherently a market function. There is someone that's getting paid to offer the compute and storage, and if this kind of movements were to take up a majority of the I guess interactions between the demand side and supply side of the blocks, it becomes one side is going to be worse off over the long term. So we see a lot of interest, a lot of philosophical discussions, or especially on the Ethereum side, to push for this kind of like physically settled inclusion list, pre-confirmation. There's a lot of very interesting ideas that are getting pushed. Pepsi, however, I think they're much more those kind of solutions are much more interesting for MEV searchers who are trying to really get granular on the sequence of their transactions and being able to lock in a specific sequence of events such that they maximize their profit. But it's less interesting for end users who are trying to have a stable and predictable fee experience over a period of time, nor is it interesting for proposers who are trying to have a more stable revenue source. So, given all of that, I think it's just not as interesting to explore. It's technical from engineering perspective. It's much more interesting to explore physically settled solutions, but from end users' point of view, I think they're creating problems for themselves, and I think synthetic approach is much more reasonable. It's much less impactful to how the actual block space dynamics, because it has no impact. Well, in theory, it should have no impact because it lives in a different dimension, and looking at how traditional energy market, commodities market have developed. Not saying that this is going to be one to one, but these kind of paper market where information changes the price of these futures market. The paper energy market have much greater volume compared to the desire to interact with the bearers of oils, right? Like,
Yeah, well, that's how we got Super Contango last year. Why did you start with Bitcoin? I mean, Ethereum has more fees in economic terms, and so apparently Solana is catching up to Ethereum now. So why Bitcoin? Why Bitcoin on Ethereum?
Yeah. The Ethereum product is always in the work. This actually we've been working on the Ethereum, the base fee product for a longer time compared to the Bitcoin product. This is going to get into slightly more nuanced territory, but for the base fee product, there's no natural producer of base fee because base fee is entirely burnt. Even on the sell side, anyone who so for the seller side, this would be anyone who's interested in just selling ETH in the format of base fee. It's very speculative. It requires tons of like financial alchemy. It's possible, but it requires tons of coordination work. It requires the market to take a long time to form that consensus. I think for Bitcoin, such a problem doesn't really exist. Well, Bitcoin instrument has other problems, such as there's no native smart contract to support Bitcoin. But
Right.
yeah, so it's we're trading the market structuring challenge for a different set of challenge by focusing on Bitcoin first. With Bitcoin, they are a natural producer of transaction fees. So anyone who's taking on the short side, they as miners, they're not taking on an entirely speculative risk to short transaction fee, which is a very unnatural behavior. If you think like, there's very few people in the world wakes up and look at the chart and think, I'm going to short transaction fee today because for whatever reason, I think it's going down, right? Unless you have a very
Right.
solid quantitative model that tell you such is the case, which we do expect that to happen sooner or later. But right now, I think not that many people are just looking at the fee decay of transaction fees, like the rate of decay of transaction fees. Um, so
Yeah.
for miners, this is really okay. I naturally producing fees, right? They're like farmers growing vegetables. I'm naturally producing these crops, and now I'm selling them as futures. And if I lose money on the futures, that I'm not losing money on my like entire crop because I'm not selling more than what I'm growing. And if they make money on these futures, that's great. That's a yield enhancement on their vegetables.
Okay. What other products aside from fees are you thinking about, or are you just laser focused on fees at the moment?
I think fees are the most interesting because this is an experience that affect everybody, every end users, and I think this hasn't been that big of a talking point before. Well, people talk about it when gas fee is high, but people cease to talk about it the moment it drops. This kind of volatility, it is still a very much a long term challenge. It's not a long term challenge for end users who would show up and do something and then they go back to their regular lives. But this is a problem for commerce. This is a problem for people for businesses that are settling every single day, posting multiple transactions every single day. So that kind of volatility is very painful for them from a cost management perspective. The 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 market for this the demand for this type of instrument is growing very, very fast as more mature businesses are starting to become entirely on chain. We've seen this with sequencers, obviously, with some wallets, with bridges, with some of the more consistent on-chain traders. I think if the belief is that crypto is going to attract a greater amount of economics to happen on chain, it's safe to assume that there will be greater volatility introduced by these kind of commerces and also greater amount of volatility born by these kind of commerces over time. And there's only so much high quality block space that we can use, right? And the scaling high quality block space is very slow and it's inelastic. And of course the Polkadot folks that have a pretty advanced view on this. Curious to see how that goes, but with more, I guess, conventional public blockchains, this is such is the case, right? Like scaling block space is very slow. Scaling is very it takes like a lots of VC money. It takes a lot of time and resources, but demand there is ephemeral. It comes and go very fast. So that's why people would often complain. So there would be a period of time where people complain about gas being too damn high and Ethereum is unusable.
Hmm.
And when runes started to first come right after the halving block, people are like, okay, Bitcoin's now unusable. We need to fucking censor these transactions. We need to, like these people are spamming. These people are killing my sacred baby Bitcoin. Um, and the narrative switches to well, sorry, regarding Ethereum scaling. After a while, the narrative switched to, oh my god, we have so many infrastructures, we have all these high FDV coins that because people are just funding fucking infrastructures, we don't have any apps, we don't have users. How about we figure out where the users are before we do these scaling solutions, which only benefit, the money that created this thing. So we go through these cycles, right? And if I remember correctly, it was Fred Wilson or someone from USV team wrote in 2018 or around that period of time. It's a application cycle,
Yeah, the myth of the infrastructure phase, right?
something like
I
that.
think was the name of the blog post.
Yeah,
Yeah, I remember it very well. And they said it was an interplay between applications and infrastructures rather than a single phase.
I think the core points in that blog post still rings true, right? And especially for something like crypto, where uh, there's a lot of mercenary interest for specific ecosystems. One particular ecosystem scales very fast, and now all of a sudden has a lot of capacity, a lot of grants to throw around to attract this kind of mercenary and partly organic usage. And these applications comes, these kind of interest comes, they congest the network, make them unusable, and then there's renewed interest in scaling these systems. And such is the case that we see on Bitcoin now, that we see with Ornos pushing the fees to a very high level since November of last year. Start of November of last year, the mempool became much more full. The blocks became much more full, and we see more these kind of out of band payments. We see more of these kind of solutions that are trying to structure non-standard blocks that are otherwise not appropriate for Bitcoin Core's relay policies. And we see these kind of changes, and that pushes renewed interest in scaling Bitcoin, which we haven't heard these two words together for a very long time. Scaling and Bitcoin. These two words haven't been together in I don't know, this is years. And now all these various solutions, they start to get funded, they start to for whatever reasons, for reasons that are somewhat obviously speculative, some are really trying to solve this problem. But I think the underlying theme is exactly what the Fred Wilson article talked about.
I take it you're kind of structurally bullish Bitcoin fees in the long term, albeit with lots of volatility.
Myself, yeah, 100.
Yeah.
Yeah, I think one topic, one very touchy, sensitive topic that we hadn't talked about in a while is security budget after rounds and rounds and rounds of halving. And
We used to talk about it. Yeah. I mean, every halving it becomes more relevant. We still don't talk about it. So,
I think the people who were really who talked about it were pushed out because they're marked as concerned crows or idiots, right? Colorful words that max.
they didn't fire me. They tried. They couldn't fire me. You can't fire anyone from Bitcoin. That's the thing.
Yeah,
But you can make someone disillusioned and stop talking about it. That's true.
happens so often, right? I think especially back in the days when the I guess cultural diversity of Bitcoin was not nearly as strong as today. There's a much there's much more concentrated, I guess, weight from the people who do not want to talk about it, or just have triggered a reaction every time they see this kind of sincere technical conversations. And at the time, people who wanted to have this kind of, serious technical discussions were like I said, disillusioned. They went to do more interesting things. I was seeing quite a few of them, right? Like in a on the journey of attempts at scaling Bitcoin. I think what changed now is that there's a much greater influx of new people with different opinions about how Bitcoin should be used. I mean, for better or worse, this is not going back, right? This has changed, and with this new cultural diversity, I think there are more forces from different directions that trying to shape the Bitcoin the way that they see as appropriate. Um, so it's not as I think this has been talked about many times, but it's not so monotonic anymore. There's
Yeah.
yeah. So I think it's very interesting to see.
That's why we call it Bitcoin season two. That's why we say there's a Bitcoin renaissance. It's a cultural shift as well as a technical one. And I think the technical shift and the capital allocation shift is a reaction to the cultural shift. So, I mean, even Alkimiya, like the notion of a Bitcoin product built on Ethereum, that is heresy historically, at least for a portion of the Bitcoin ecosystem. But now I don't think people bat an eye at it. I mean, there's no way to do it on Bitcoin currently. So you're a part of this as well.
Oh, 100%. I mean, I was a Bitcoin maxi for a good amount of my, I guess, journey into crypto. And for me, it was a very practical thing. Okay, I want to work with Bitcoin. I wanted to build stuff that allow people to make Bitcoin more interesting. I couldn't. I either build a fucking centralized thing, which I have zero desire to, or I choose DeFi, and I chose DeFi.
Yeah. Yeah. I mean, which one of us quit being a maxi first? Do you remember? Because I think I quit in 2021, if I remember correctly. That's when I definitively quit.
I I think privately we probably quit around the same
Yeah.
time. Publicly, I think you defected. Well, okay. Publicly, I never really like had a
Yeah, this is it. This is your this is your 95 theses nailing them to the church door. This is you. This is your Martin Luther moment right now.
Yeah. I think I just
He's admitted it.
quietly walked away, and I don't think anybody think of me as Maxi after I don't know 2022 when I came out and said hey, that we were building our alpha version on Avalanche. I think at that point I think there was no
Yeah, that
yeah.
that left no doubt. But it's true. Like the Venn diagram of hardcore maxis. I don't know. I guess we're not allowed to call them that. Is that a slur? The laser eyes and the Venn diagram of people that are trying to actually build decentralized technologies has very little overlap because there's so little you can do with Bitcoin in its present form. That might change. We have all these new L2s. We'll see, what happens there. Obviously, we have our exposures. Castle Island, we're very active investing there. But I don't think the laser eyes actually support the L2s. They only want to use kind of orthodox Bitcoin, layer one existing Bitcoin with the very limited scripting language or Lightning at most. So the builders tend to try and experiment and then move away from the very puritanical culture by virtue of the fact they're trying to build something.
Yeah, I think season two of Bitcoin is definitely marked by it's definitely triggered by cultural shift first, right? And of course, I think if we zoom out, there's Bitcoin ETF that kind of fueled it, but all these things are just perfect storm that led to where we are today. I think with Bitcoin L2s, yes, a lot of people shit on them. While the good amount of them are definitely lazy solutions with their goal very clear. That's there's no illusion regarding what they're trying to do. But there's some groups that are really trying to bring this kind of solution to Bitcoin, right? I think whether they're successful or not long term, this is a very valid effort. This is something that people should try, and this is the best time to try it. Um, I think if people are able to use Bitcoins as settlement layer for these kind of higher order primitives, I think that's awesome. There's absolutely, I can't think of a single reason to stop people from doing that.
Last thing, we've had you on for a while. What catalyst do you see for Bitcoin fees that are the most important in kind of the near and medium term? What protocols do you think are going to drive fee pressure here?
The most short term is definitely runes. I think the toolings for runes haven't been properly built up yet, so the UX for runes pretty terrible. I think we likely will see another wave of interest of playing with these kind of things. I think it'll be very interesting to see what happens after Rune native infrastructure like Rune dexes, all these kind of pretty pretty uh, I wouldn't call them the most technically advanced, but very interesting ideas that can change the dynamics. I think overall the fee as portion of the block rewards has become a much greater portion. The this event itself introduces tons of volatility to miners first of all, and as for the usage of fees, I think it's still going to be very much event driven for a foreseeable amount of time, until whether it's Bitcoin L2s or Babylons of the world, they create more consistent usage pattern. They're able to bring more natural organic usage to build on top of them so that we see more predictable or more consistent usage of Bitcoin block space.
So you're launching next month. Where should our listeners go to either learn more or even get started with Alkimiya?
It's alkimiya.io. And I think the everything else should be pretty self-explanatory.
Yeah, what's funny is I wrote this article. I don't know if you remember it. Public blockchain fee cyclicality back in 2020. I don't expect you to have committed my entire corpus to memory. That's okay. And I wrote about negative feedback loops in fees, transaction count and fee, the interplay. And I noticed that basically peaks in transaction count tended to precede fee peaks, and then fee peaks would cause transaction intensity to decline. So basically, as users responded to the real-time condition of fees, it would cause blockchain utilization to go down. My case study was actually 2017. We have a lot more data now, but that was kind of the main burst of fee activity we saw in Bitcoin. And I remember at the time thinking to myself, wow, I wish I had a way to speculate on fees, because I figured out the pattern, basically. It didn't exist. So my dream has been realized 4 years later. So thank you.
Oh, so that's why you asked me to leave my old job to do this.
I mean, I've always been like very curious about the topic, and I'll put the article in the show notes. But yeah, I mean, the interplay between blockchain utilization and fees, and then that fee pressure causes users to migrate to other L2s or to competitive L1s. Like, that's a very interesting field that I don't think has been like really studied yet. I mean, for instance, what's the effect of an L2? Does it decrease fees on the L1? Does it increase fees because it creates a new transactional venue which creates more demand? We don't know the answers to these questions.
Yeah, I think we can see some of the trends slash patterns on how Ethereum evolved. I definitely don't expect the Bitcoin L2 space to evolve in a similar way as ETH rollups. I think they made a lot of mistakes there, which is a whole nother king of horn. but but I think the pattern that you observed back in 2017, this it still stands, right? So like, the transaction counts increases, the blocks becomes more full. Some of the transactions that are trying to get through, they need to pay a higher price, right? And the smart fee estimate that's the RPC endpoint that a lot of wallets use to do fee estimations for a number of blocks that people want to include. That increases very quickly because they observe mempool usage for the past X number of blocks. But anyways, so it has a very mechanical reaction. It has a very like clear causal relations to fee spikes, and fee spikes, of course, that decreases the desire to get transactions fast. And there's little reason at the time to send transactions ASAP. Because the kind of arbitrage opportunity, high value sniping that now is starting to infest the mempool. These kind of activities they did not exist back then. So there's like greater reactionary speed to these two factors. Now there are more factors that are in play: time preference, transaction size. Different transactions have different preference for fee tiers, right? Some transactions they need the absolute the top of the block. Some transactions are more chill. I think these are factors that changes the dynamics a lot. And so when we update this study, we'll include many more factors, and I'm sure a lot of interesting things will come out of it.
Well, I'm looking forward to it and excited for the launch. Leo, thanks for joining us today.
Thanks for having me.